Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Friday, February 28th, 2025. Today's episode begins with bringing up the PCE data coming out today. This is the Fed favorite inflation gauge. It met market expectations across the board. From Market Watch, we have the last reading, the expected, and the actual. The PCE index itself coming in the same as the last, the same as expected at 0.3% year over year, coming in exactly as expected, even in the core as well, exactly as expected, 0.3%, and year over year, exactly as expected by the market. Some people are interpreting this as inflation being sticky at this level. I'm in the camp that the Fed is tight here, and we still have our foot on the brake, and we're waiting before things turn and accelerate to the downside, and it hasn't happened exactly yet. The way that I see it, Mr. Market is standing on the ice. It's warming up. The ice is cracking, but it hasn't broken yet. We'll get there when we get there. Next agenda item, the 10-year 3-month inversion is deepening today. After uninverting on Friday, December 13th of 2024, we just recently on February 25th went to 0.26 and inverted again, and then we further inverted today, now sitting at negative 0.08%. And this represents that much of a higher yield on what you can get on a 3-month Treasury than what you can get on a 10-year Treasury. I want to emphasize once again, this entire period where the Fed was cutting and then the 10-year note yield went up and up and up, the market was saying, and everyone was interpreting it to say, the Fed cut too much, too aggressively, they cut too aggressively, too quickly, and now the market's worried about more inflation, and that's where we are. The yields are just going to keep going up. We're in the opposite camp. We're in the opposite camp so much that the 10-year is actually back below the 3-month Treasury, meaning that the market is now saying very explicitly that they are expecting the Fed to be behind on the cutting cycle. And I think that is the more reasonable position, largely because that's how every cycle pretty much works. The Fed is always behind. That's how they operate. They operate on lagging data, and when they change their monetary policy, those changes often don't have an effect on the economy for as much as a year or a year and a half. Last agenda item, next Friday, jobs report. The unemployment report coming out. This is the other piece of information that the Fed uses more than any other piece of data, really. It's the PCE data for figuring out what is inflation doing exactly, and the jobs data to reach their other mandate of stable employment. This is the other metric. So next Friday is a big one, of course. We've kind of paused at this 4.0 now unemployment rate. Are we going higher, or are we turning back to the downside? We'll see. My suspicion with my crystal ball and all is unemployment is about to start going up and then accelerating up. But that's just me and my crystal ball. No major changes to the daily reminders. Watch Macro Update 211 to hear me explain all of these. We've had the PE ratio and CAPE ratio kind of bounce around 29 through 31 and 37 to 39 in the CAPE ratio. And then I added one thing today, I think, or yesterday. I don't know if I talked about it yet, but fiscal response, spending cuts are occurring. And, a lot of the idea that inflation is going to stay high has to do with the idea that our new administration in charge of government is not interested in cutting spending. And yet I'm seeing headline after headline saying that they are cutting spending. And then I also hear people saying, well, the amount that they're cutting isn't enough. because it's not going to affect the deficit sufficiently. And I'm going to add to that, okay, but look at what they're cutting. They're cutting people's jobs. These people that are now not going to have their basically guaranteed government jobs anymore either need to find another little niche in the government, or fill in the job openings that are available in the private sector, which is better for the economy. The more power and weight there is in the private sector, the better the economy tends to be, simply because government spending, and this is not a political view, this is a historic, very true way of seeing the world. Government spending is not something that creates a great economy, let's say. Quite the opposite. Says every time in history governments try to overspend. I mean, anyway. Also, no changes in the crystal ball ratings. Watch portfolio update to 11/25 to hear me read through and explain my crystal ball ratings and my own investment portfolio. So let's dive into the charts. We start with the S&P 500, the SPX having a pretty big green candle to the upside, not negating yesterday's red candle. So this looks more bearish than bullish, but it certainly took a lot of the bearishness out of the market and increased the likelihood of going sideways at the moment. I found another line, this green line. I hope you can see the difference. Going back to August of 2024 low, connecting to January 2025. Sorry, that's January 13th. To the top of this green candle. It looks like that may be serving as a place that we broke, and then we touched it today exactly to the button. So it looks like this is providing resistance at the moment. I'm going to get rid of this blue line because it doesn't seem to have much significance anymore to the market. So yeah, my best guess at this point is that we'll at least make our way down to this line around the 5,500 level in the S&P 500. That looks to me like the most likely outcome in the immediate future. TLT, still my favorite place to be, going up by 1.23% today. I mentioned it looked like we had gapped out of this downward channel that we had previously, and that typically means that bullishness will occur, and that's what we're seeing exactly right now. Part of this is the fear of inflation. The people that think that inflation is just high and they're just going to stay high or tick back up, they're getting a little nervous about that idea now. That's kind of the way I see it, and so that's why longer yields can drop here. Like I said earlier in the show, the notable part is the 10-year dropping below the 3-month. So it dropping so much that now the market is saying, hey, Fed, you're strangling the economy here. You're choking it. You're no longer, it's no longer looking like, the Fed's trying to give the market, put the market back to life. It was doing that for a little bit when the 10-year yield was spiking up, but now it's the opposite. We're choking them again. Anyway, moving on, the price of Bitcoin kind of in no man's land. Looking over here, there's no areas of that much interest in the recent past, and we're developing what appears to be a pretty clear bear flag at the moment. I expect this to continue to the downside. Lots of people are expecting to get a lot of buying happening at 75,000 from there. We could go back up, or we could continue lower, but there'll definitely be a bit of fight there at 75,000. I wanted to bring up DXY today only because it looks like we may have broken out of a bit of a trend line. If you take January 13th's high, connect it to the highs around February 11th, and it connected perfectly to the top of Thursday's candle. We broke above that with a green candle, based on that trend line, this is looking like a bullish dollar. It kind of looks like it wants to go up. Crude oil still looking pretty interesting. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. I think this is it. I think this is the last run. I think we're going to crack 67. I think we're going down to the $35 a barrel oil in the very near future. Combine very recent data with, the M2 money velocity ticking downward. People are saving more. They're spending less. This is all while inflation is not going up nor down, just flat. This is all while the SOM rule was triggered. Again, watch the macro show to hear all the rest of it, but we're here. The stuff's about to hit the fan, in my strong estimation. Last chart of today is gold. If you remember from Tuesday, I talked about this red candle, or I think it was Wednesday I mentioned it. It looked like a bear flag, and I said this looks bearish, and yeah, it's been going down. Again, looks like we'll probably have buyers around the 27.89 level. At least some buyers. There's a lot of bullishness in gold, and it's so funny, even really good chartists like Gareth Soloway out there, they are looking at gold and they're expecting it to just go higher and higher and higher, and I can't help relate to what's going on today with gold as to what happened when we first, for about a decade after we got off of the gold standard. Let me show you that chart. So this is a monthly chart, so the data is more crammed together than the daily chart that I normally look at. But 1971, this is when we were at $35 an ounce in gold, and the dollar was still backed by the gold. We came off of the gold standard for the dollar, and we spiked all the way up to a peak of $198 per ounce of gold. Very notably, from that peak, did it stay high forever? There were plenty of people buying in this entire area thinking gold, was just destined to keep going up. Why would you buy gold unless you thought for sure it was going to keep going up? And then what happened pretty soon after, we went down almost 50% in gold within a year from then, beginning of really 1975 until August of 1976, dropped by 50%. For people that think gold can't go down in price to the dollar, guys, Mr. Market does. How many times do we have to play the same darn game again? So from that price, which turned out to be a great buying point after it had dropped 50%, by the way, we had massive run in the late 70s with major inflation going on all the way to a peak of $880 an ounce of gold. And remember, people were buying up here in this range thinking, oh man, gold's just going to be worth an infinite amount of money. It's just going to go to, I don't know, $10,000 an ounce was probably the thought many people had. If you, followed this line up and just thought like it would keep going in that same direction, yeah, you thought you were going to get rich by buying gold in this range. Now, look at what had happened after 1980 in the price of gold. How long did it take to get to that peak of $870 an ounce? Well, 1980, we didn't see that price again until 2007. So if my math is correct, that was 27 years before we saw gold get back to its previous peak in 1980. Imagine waiting 27 years for your investment just to break even. And again, this isn't in purchasing power. This is in dollar amounts. And so to get your dollar, for it to have turned into a good investment, considering for inflation, you would have had to wait longer than that before feeling okay about your investment that you made over 27 years ago. And in the meantime, we had gotten down to a low of $253. So over, sorry if my math's not perfect, something like 60% of a drop in the price. And then moving forward, another great big bull run in gold, peaking at 1922 in 2011, and then going down by, again, about 50%. And then to get back up to that same price, you would have had to wait about 9 years to get there. Now, what has happened today? Well, we got to new highs. We went from the low of 2022 of around $1,600 to almost $3,000. That's almost a 100% gain right there. So what happens next? Does it keep going up? Well, maybe. But do you know when the music stops? Do you know when it's going to collapse 50% and then not recover for another 27 years again? As if that's never going to possibly ever happen in the future ever again. Guys, this is an easy game to see. This isn't a hard game to play. If this wasn't real money and you were just playing a video game, you'd see the pattern and you wouldn't be buying gold right now. People that are bullish on gold right now, I wish you the best of luck. And I am going to say it does not appear to be a safe investment from my perspective at this moment in time. It regularly drops by 50% in price, and that's probably a decent time to buy gold. Not right now, when we are inches away from all-time highs, and we have no idea how high it's going to go, and we have no idea when Mr. Market's going to pull the rug, and people don't think the little shiny rocks are, all that great for a while. Gold always has its booms and busts. One of the primary ideas of Benjamin Graham that made him so successful is he doesn't bother trying to play the game of how high can things go. He only tries to find things that seem obscenely cheap, because things are safe when they are obscenely cheap, because they can only go down so much, and there's so much more room for the price to expand. Buying things at all-time highs is the absolute opposite. It seems like it's worth a lot of money because people are paying more money for it than they ever have before. This is where Mr. Market just simply gets it all wrong every single time. People see a price tag on something, they say, whoa, that's really expensive. That must be worth a lot. I'm going to buy that thing, and it's probably going to be even worth more tomorrow. It seems like a safe place to put my money because it's very expensive. It's the opposite. The reality is the opposite. Something that is very cheap is something that has safety. Something that is very expensive does not have hardly any safety at all, and in fact should be screaming, danger, 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 danger. There should be a bell going off in your head. Hey, this is expensive. Danger bell, as it is in my head. I'm not touching gold with a 50-foot pole until it drops by at least 40%. And that's how I'm going to play this game. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.